Yeah. It's 1 o'clock, Emily. Jeez. Just give it 1 minute and then we'll get started. All right. Well, thank you guys for joining. So, my name is Mark LaMonica. We are going to talk about income investing today, which is always an exciting topic for everyone, I think. But a couple things. You can, of course, listen to our podcast, Investing Compass, and follow us on Instagram. So tomorrow, I am going to make macaroni and cheese and talk about diversifying your portfolio and put that on Instagram. So I don't know if it'll go up tomorrow, but we're going to film it tomorrow. So what else do you need other than that? So as I said, we're going to talk about income investing today. If you have any questions, that is my email address. But I have a couple of housekeeping items. So everything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can get a copy of our FAP off of our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. So with that out of the way, we're going to talk about income investing. And income investing is very popular with lots of people. And we've got this quote from Rockefeller about how the only thing that gives him pleasure is to see his dividends coming in. So I think it's enjoyable to get dividends, but that's also probably a little bit of a sad life. But anyway, why do people like income investing so much? Well, I think it's around this concept of passive income. So passive income, of course, is income that you earn without directly working for it. So an example of passive income is, of course, dividends, but it can be anything that an investment generates. Whether you own investment property and you are making more back in rent than you're paying for your mortgage, whether you're getting income from bonds or the little bit that you get from cash. Passive income is this idea of generating income without doing work for it. It's really tied up in this concept around financial independence. Of course, being independent, a lot of people think of that as, yes, the ability to pay your expenses and fund your life without directly having to work for it. Whether you want to continue to work or not, it's just a very attractive concept. So we want to talk about a couple of the other benefits. We will talk about what you should think about if this is your goal eventually, or if this is something you've actually achieved, how to maintain it. So we'll talk about some considerations there, but we want to talk about some of the other good things about income investing. And we want to talk about, number one, that it is a large and probably unappreciated component of total returns, and that dividend paying shares have a lot of benefits. One of which is lowering volatility. So we'll talk about that. But also, I think it's worth stepping back and talking about sort of the market environment in general now. Obviously, we've seen a lot of volatility this year, especially in April and the beginning of May. And volatility, of course, is a fancy way of saying the market went down. And a lot of people believe, myself included, that we are actually at an inflection point where a lot of the things that we've seen really since the GFC, but in particular since the COVID market drop, which has been pretty much rampant speculation, is actually changing. And perhaps we're at an inflection point where we are going back and looking at fundamentals again. So fundamentals in that we are looking for companies that are generating cash flows, earnings, and pay dividends. So a lot of stuff that always tends to fall out of favor when you are having these huge market gains, which normally are driven by the more speculative side of the market. And what we've seen happen, and if people listen to our latest podcast episode, we talked about this, but what we've seen happen, of course, is we've seen the speculative parts of the market come back to earth, come way back to earth. Sort of started with the most speculative parts of the market. We're seeing a lot of tech companies. We saw a lot of small tech companies fall significantly going into the fourth quarter. We've, of course, seen it with other riskier assets like Bitcoin and other cryptocurrencies. And now, of course, it's starting to spread still to the more speculative parts, the higher valuation parts of the market. So this could be an opportunity where, once again, we can remind ourselves that income is a big portion of total returns. All right, so let's talk about how big of a component of total returns income is and how this has fluctuated over time. So we've got a couple stats in here that we can go through. And we've got a nice little chart that Fidelity put together. So first of all, let's talk about the local market. We'll talk about some of the differences between local market and global markets, particularly the US. So we can see that according to the AFR, dividends contributed 53% of total market returns in Australia since 1900. So that's a big amount. So for those of you that are not mathematically inclined, that's more than half. And we can see in the US, we've got a lower percentage. So let's talk a little bit about that difference. So traditionally, and I think certainly recently because of tax policy changes, dividends are desired by Australian investors probably more than other investors. And there's a couple of different components to this. But in general, Australian companies, and if we look at the indexes, Australian companies pay higher dividends than companies in the US, for example. And a lot of this, of course, is the benefits of franking credits and how those can be passed on. And that's obviously developed a big preference in the local investors for dividends. So that's one thing. Now, the reason that they're able to pay out more in dividends is because the reason they're able to pay higher yields is because they are actually paying out more. So if you go and look at payout rates, so the payout rate is the amount a company pays in dividends compared to earnings. They are higher in Australia. And then finally, another contributing factor is the makeup of the market. So traditionally, technology shares and growth shares have paid less out in dividends, which makes sense because what they're trying to do is, of course, invest money back into a fast-growing business instead of giving it to shareholders, versus the type of companies that dominate the ASX, like banks, who traditionally have very high payout rates. And we've also seen resource companies start to pay out a lot more in dividends. So there was, back earlier this century, there was certainly a case where there was a lot of investment from the miners into new production, and it wasn't that efficient. Shareholders didn't really like that, and since then have shown once again a preference for dividends. So you are getting higher dividends in Australia, so it does make sense that it makes up a higher amount of the total returns. So let's go over and look at this chart for a second, because I do want to talk about, of course, that there are situations where dividends fall in and out of favor. So in particular, some of these growth phases of the market, so kind of what we've gone through the past couple of years, where you see all these growth shares and extremely high returns, a lot of investors say they don't care about dividends during those periods. And of course, when the market does not perform as well, all of a sudden, everyone cares about them again. So this is looking at the US market. So what you can see by decade since the 1930s, you can see the total annual return in the S&P 500, and then the amount that was contributed to by income, so the amount of that total return. So what you can see is that it has gone down over time. And I think we've seen this in this sort of large, if we look at sort of the drop, like the 80s and 90s, we've had this large drop in interest rates over that period of time. And that, of course, has pushed up valuations, meaning that investors are getting more of their total return from changes in valuation level rather than income. But this could be a point in time where income comes back into favor. And then another thing that I mention a lot on here, because I think it's interesting and I think that people think it's interesting, but Jeremy Siegel wrote a couple books, one of which is called The Future for Investors. And he went back and he wrote this book, a little while ago. So 2006 or 7, he wrote the book, but his study went 2005. He went back and he said, okay, if I start in 1925, what is the best performing US share? And he found that it was Philip Morris, and that it was Philip Morris by a lot. And so $1,000 invested in Philip Morris in 1925 would be worth around $250 million in 2005, which is pretty incredible, and involved reinvested dividends. We're going to talk about sort of the lessons from this a couple of times. But of course, Philip Morris is a tobacco company. As you can imagine, during this period, there was, and smoking peaked around 1960 in the US, but there was, of course, the product they sold became a lot less popular. There was a lot of regulation put around smoking, and there were a lot of lawsuits, government and non-government lawsuits around smoking, yet still, this was a top performing share. And a lot of it had to do with dividends, and a lot of it had to do with low expectations from investors, which meant the valuation level was low, which meant as you're reinvesting those dividends, you're reinvesting them in a higher yield. So just something to think about. All right, so let's move on. Another thing that we can talk about in terms of contribution to market returns, which is probably pretty relevant right now, is that during periods of high inflation, stocks that increase their dividends the most considerably outperform the market. So basically what this study did is it looked at the relative performance and basically dividing up periods of inflation into the lowest periods of inflation and the highest periods of inflation, and looked at the shares, and this is a US study in the S&P 500 that grew dividends the most. And you can see, obviously, right here, that in high periods of inflation, if you can find companies that can continue to grow dividends, you're going to do pretty well. Now, there's a couple caveats to this. This, of course, looks good, but there's a couple caveats. Number one, you do need to identify those companies that can continue to grow dividends. Number two, dividends, and one of the reasons I like them, and one of the reasons a lot of investors like them, is because they are real, right? So at the end of the day, when we sit there and we look at accounting, and I'm not saying there are any accounting tricks, although that has happened in the past, but accounting is a little bit different. The accounting that we use to, accrual accounting to generate profits and to measure earnings are different from cash flows. And what do you need to pay dividends? You need cash. So over time, of course, you cannot hide the fact that your business is not generating cash if you're paying out dividends, because you need to, of course, fund those. And if we think about an inflationary environment, what are the companies that do well? Well, those are the companies that are able to pass on inflation on the cost side into the products they sell. And of course, those are companies that are raising their dividends. So it is, of course, just an indicator of who's doing well in an inflationary environment. All right. The other thing, of course, that's good about dividends that we mentioned before is lower volatility. So lower volatility, of course, means how much does something bounce around in price. And once again, we've got a US survey on here, but I think the concept is applicable. We can see, first of all, the S&P 500 dividend aristocrats. So those are companies in the S&P 500 that increase their dividend each of the last 25 years. I'll explain in a second. US dividends are a little different. They produce higher returns and meaningfully higher returns in the overall market and less volatility. So that volatility measure we're showing there is the standard deviation. So let me quickly explain what that means, and we'll talk about beta as well, because we're about to use that. So basically, the standard deviation is a volatility measure. So what it looks at is the average returns over a certain time period, and then the dispersion of the actual returns around that average. So remember, a big dispersion means that maybe average returns are 10%, but some years you're getting 50%, and some years you're getting negative 30%. So that would be a reflection of dispersion. So the larger the standard deviation is, the larger the dispersion is around the average, which means more volatile. So it's a very brief description of standard deviation. So there is a study done that Hartford Funds did and looked at 1973 to 2021. So it looked at annual returns and then volatility by dividend policy. So firms that were growing their dividends, firms that just pay dividends, firms that did not change their dividend policy at all, non-payers, cutters, etc. You guys can read. So what it's looking at is returns. So obviously companies that are growing dividends have higher returns. That it looks at two measures of volatility. So beta refers to how does a share price perform in relation to the overall market. So in this case, the S&P 500. So a beta that is higher than 1 means that that share price is going to do better when the market's going up and do worse when the market's going down. So that's what beta means. A beta of 1 means it would move exactly the same way the market went. The market goes up 10%, it goes up 10%. Market goes down 10%, it goes down 10%. That's a beta of 1. Then any beta below 1 means that it is not going to go up as much when the market goes up and not going to go up as much or not go down as much when the market goes down. So what we're showing here, and you can tell by the standard deviations, the more that a company pays dividend and grows its dividend, the less volatile it's going to be. Now, volatility when the market's going up, once again, can be a good thing. It means that the share is potentially going up more than the market. But if you are trying to protect yourself on the downside, if you're okay, maybe giving up some returns, and in this case, you really haven't over the long term, if you're okay giving up some returns when we have these sky high markets that are going up, you're going to be protected on the downside. You can make up for it. So obviously, if we look at what's happening right now with the market, this 100% is happening. So if you look at some of the NASDAQ, for example, a lot of technology shares, a lot of growth shares, high valuation. Well, obviously moves around a little bit, but last week it was down roughly 28% for the year. S&P 500 was down like 18% for a year. Some dividend paying shares, we start looking at those. Well, okay, they are down less. So it does provide downside protection, does limit volatility, especially if you're at a phase in your life where you really want to do that, particularly as you're moving into retirement. So something to think about. Another good thing about dividends. Okay, a good question from Ronald Adams. So what do you feel would happen to ASX dividends if franking credits are no longer available? Listen, my guess is that there would not be some giant cut. My guess would be over time, companies would elect to pay out less. That payout rate would go down over time. Instead, they would reinvest back in the business. Maybe there would be more share buybacks. So for instance, if you look at the US market versus the Australian market, and that was a good time to get in a couple of the differences, there is a preference in many ways for buybacks in the US. So that's when a company is buying back shares in the open market. It is a way to return capital to shareholders, just like a dividend. There are some arguments why it could be worse or better. But anyway, I think they potentially would in the future return capital to shareholders in a different way. That is, of course, a guess, but I will say that tax policy does have a lot to do with this. And I think the US is actually an example. So under George W. Bush, there was a cut in dividend taxes. So basically, dividend taxes in the US used to be paid at a marginal level, whatever your marginal tax rate is. And George W. Bush said is that is in fact unfair, because as the owners of a company, you are, of course, paying taxes once when the company you own makes a profit, and then you're paying taxes again when the company gives the profit to you as the owner of the company. And that is, of course, the same justification around franking credits. Now, the US did not go as far as Australia did. What they basically did is they cut those marginal taxes for most people from their marginal tax rate down to 15%. So this was a pretty steep reduction, not as far as like a fully franked dividend, but still a pretty steep reduction. And the dividend level in the US went up a fair amount right after that. So something to think about. I obviously don't know what exactly would happen, but I think that that's a pretty good guess. The other difference that I would say, and we'll get into this in a second around volatility of dividends, is that because US companies do not pay out as much of their earnings in dividends, they tend not to have them fluctuate as much. It is a very I would say just from a market standpoint, cutting a dividend in the US is a very big deal. And companies try to avoid that as much as possible. Where I think that investors in Australia are more comfortable with fluctuations in dividend levels as earnings fluctuate. So just something to think about. So the direction overall may be up, but you may have more volatility in that dividend amount in Australia, where the U.S. companies try very hard not to cut their dividend. So something to think about. All right, so let's talk about a couple considerations. So let's say whether you just want to lower the volatility of your portfolio, whether you, and as some of the stats have shown, you just want to try to invest in a strategy that over the long term has delivered higher returns, or if you want this dream of passive income, which we'll talk about for a second. We'll talk about why this is so attractive. So I think it's attractive from an overall, just this notion of financial independence, but it's also attractive if we think about some of the things that we struggle with as investors. One of the major things that we struggle with is that when we stop contributing to accounts and start to use the accounts to pay for our lives. And this really, of course, is retirement at the end of the day for most people, whether that is an early retirement or whether you are retiring, quote unquote, on time, and you hit preservation age, or of course, a late retirement. And one of the big struggles, of course, as people who have watched these before, you always go through during these periods is, okay, how do I actually do that? How do I take this amount of money that I've amassed in my portfolio and use it to pay for my life? And we have plenty of webinars where we've walked through there, but at the end of the day, you need to obviously set yourself up with a sustainable withdrawal rate so that your money lasts as long as your life lasts in the case of retirement. And the risks that we struggle with when we do this is we struggle with something called sequencing risk. So basically, you retire and returns are very negative in the early years of your retirement. As you transition into retirement, that can have lasting impacts on how long your portfolio will last. Well, one of the things that makes, of course, living off of the income from your portfolio very attractive is you don't have to sell anything. And really what's behind sequencing risk is you are selling your portfolio when the market fell significantly and you don't have as much to recover when the recovery comes in markets. You are not, of course, selling if you are just generating income out of your portfolio. So I think people find that very attractive. It also helps with longevity risk. I never sell the principal in my portfolio and I'm living off of the income, I'm not going to run out of money. So income investing and this idea of passive income is very attractive in those cases. Of course, that's difficult to do and it takes a lot of money. But anyway, let's talk about some of these different considerations. All right, respect the power of dividend reinvestment. So as investors, what we're looking to do is compound returns, right? The simple fact is that we want to earn a return on a return. So there's all sorts of examples that are always used for this, but yeah, that is ultimately what drives so many of returns. And when you think about compounding, of course, what matters is amassing a large enough portfolio so those returns on returns keep getting bigger and bigger and bigger. Dividend reinvestment can significantly accelerate that. So dividend reinvestment means that instead of taking a dividend in cash, I am reinvesting it back in those shares. So a lot of companies or your brokerage will do this automatically and for free. So instead of giving me $1 of dividends, I have $1 more shares. So it means every quarter or half year, depending upon where you're investing in Australia, every half year, when I get a dividend, I'm going to get more shares. What does that mean? It means that my next dividend should be even larger because I own more shares, and dividends, of course, are set by shares. So you can have this compounding impact on returns, this compounding impact on income if you're trying to grow your income over time. So think about dividend reinvestments, really a way to turbocharge that compounding effect, particularly if you're trying to earn income. And we've got a good Transurban example in a couple slides, so we'll go through that. All right. The other thing to really think about with any type of income investing, whether you are buying an investment property, whether you're buying bonds, whether you're buying shares, is the yield at cost. So at your cost basis really matters. So what that means is that when I invest, if I am investing at a high yield, so yield, the dividend yield is the amount of income as a percentage that you are getting on a share at a particular rate in time, the dividend yield obviously moves inversely to price. So if the share price goes up and dividend stays the same, that dividend yield's going down. And vice versa, the share price goes down and the dividend stays the same, that yield is going up. And the number that's really important to you, of course, is the yield at cost, so when you actually invest. So think about that. There are good times to invest in income shares and not great times to invest in income shares. The other big consideration, and we'll get into this around dividend safety, is don't stretch for yield. A lot of people think about this and understand sort of mathematically the benefits of investing at a really high yield. And then, of course, they just go and they look for the highest yielding shares and think, I'll just buy them. Well, they could be that way for a reason. So remember, don't stretch for yield. The highest paying shares could be because the market thinks that there's something really wrong with the company. All dividends are not contracts. They are, in fact, historical numbers. They have to be able to keep paying that dividend in the future. So be careful about stretching for yield, called the dividend trap. I buy really high dividend paying shares. You don't pay dividends in the future because markets decided that they're in trouble and they actually are in trouble and can't pay. Diversify by income source. So we always think about diversification with portfolios around the percentage of your portfolio that you put into every individual holding or every asset class. But if we start thinking about income, and if we're trying to generate income, and that's our goal, think about diversifying by income. So you don't want to put, same concept, you don't want 40% of your income coming from one source, even if it makes up a smaller part of your overall portfolio. So think about diversification that way. So whether that's looking at sectors you get income from, and that's where you have to be careful that there are certain sectors that, of course, pay out a lot higher income, like, for example, the banks, which everyone likes in Australia. But if something happens to the banks and they all cut their dividends, that doesn't do you much good. So think about diversifying those income sources. Choose the right instruments. This is very important. We'll get to this on the next slide, but there are instruments that work well with dividends and some that potentially don't. And then this big thing that everyone should know about right now, that there could be volatility in income, something really important to look at. So there was this interesting study. So once again, this is a US market study, but 2020 is a good example of this in Australia and other places. So they went back and looked at the S&P 500. They went back and looked at 150 years of dividends and tried to find places where there were bear markets for dividends. So a bear market is when the stock market goes down by 20%. So they consider a bear market for dividends is when the overall dividend level of the S&P 500 was cut by 20%. So they are pretty rare. So since the end of World War II, this has occurred once, and that was during the GFC. And if we go all the way back to 150 years, there's only been 6. There's only 6 times where S&P 500 dividend yields were cut by 20%, compared with 16 bear markets. So something to think about. But remember, there is volatility. There can be volatility in income levels. And we saw a lot of this during COVID. So in response to COVID, when we first started getting into it, we had that pretty steep market fall and nobody really knew what was going to happen. A lot of companies, of course, decided, which I think was wise, that if there were going to be big disruptions to revenue, that they were going to cut costs and try to hoard cash. So a lot went out and raised money, and a lot suspended or cut their dividend. So just remember, if it was 2020 and you were living dividend paycheck to paycheck, you could have been in trouble. So just think about that. There can be volatility, just like you would want to have, just like when we talk about the bucket method of investing, it's like you might want to have a cash bucket to protect you from market losses. You might want to have a cash bucket if you're living off of income to protect you at times, however rare, but times where stuff like that happens, when there's big cuts in income. All right, so this is our first celebrity guest. Emily, who's in the room, is really excited about our second celebrity guest. That's what she told me. She told me to keep the slide in there. So this is Tina Turner. So we've been hearing this whole thing about how there is no alternative and everyone should just invest in equities. Now, I use this little thing and get there is no alternative with Tina Turner. It's all coming together. But let's talk a little bit about where to get dividends and the advantages and disadvantages of them, because I think that this is important. So, all right, domestic shares, Aussie shares. So we'll talk about the predictability thing in a second, but franking credits are a huge advantage. How big of an advantage? Well, and I'll go back to the other slide. We took a look at franking credits over the long term for Aussie residents, obviously, so you get them, and went back and looked at the last 10 years, and we looked at total returns. So we looked at the S&P ASX 200 index. Then we looked at the total return. So this was just price returns, this line right here. I'm colorblind, so I'm not good with colors. But this line down here, looked at just price returns. Then looked at total returns. So you can see about a 4% difference in total returns versus just price returns. So total returns when we include dividends. Then we looked at franking credits. So what happened? We got almost another 2% a year. So pretty good advantage of investing in domestic shares. So a couple of the disadvantages we should talk about is more difficult to diversify your income. That's what I was talking about. If you look at the Aussie market, a lot of banks, a lot of miners. So when we talk about diversification, talking about diversifying in different industries, it's harder to do here. Smaller market, certainly that concentration in certain industries. And remember that the Aussie market is very domestically focused. So Aussie companies get a lower amount of revenue from international markets than US markets, and particularly Europe markets. European markets are generally the most diverse in terms of the percentage of revenue they get from other industries. All we're trying to say there is that if something happens to the Aussie economy, it's not great for Australian companies, whereas companies that get more revenue from overseas are in better shape. So think about that when you think about companies. So obviously the big one here is the banks. Aussie banks are very domestically focused. Every single time, seemingly, they've gone overseas to try to do something. It has not worked out. So that's a big example. Then there's some companies like a resource company, for example, that sells almost all of their products overseas. So you think about BHP and iron ore. Where's that going? It's going to China. There isn't as much domestic. So just think about that. Global shares. We'll get to this predictability thing in a second. So what can you do with global shares? Well, you are able to diversify your income sources from a wider variety of sectors and countries, of course. What are some of the issues? Well, no franking credits. In general, yields are lower. You got to worry about currency, right? So remember, as Australians, when we invest overseas, and if we're investing overseas for income, we want the Aussie dollar to go down, right? We want every time those dividends are paid, we want that Aussie dollar to keep going down. We'll get more Aussie dollars then, right? When the income's paid. But just remember that adds a certain impact, something else that you need to worry about. That if you're trying to live off of this income for retirement, the Aussie dollar starts doing extremely well, your income's going to drop that you're getting from overseas. But the advantage is it'll be cheaper for you to go travel overseas. All right, so let's talk about this item, more predictability and more difficult to diversify income. Obviously, it's more difficult to diversify income with single shares because you're buying single shares. You're going to build a whole portfolio. Let's talk about this predictability. So both ETFs and funds are essentially pass-through vehicles. What that means is that as the owner of an ETF or fund, you are going to get capital gains and you're going to get income passed through to you in a distribution. So everyone calls them dividends. My ETF paid a dividend. It didn't. Paid a distribution. Now, they're reasons why this is a little bit ridiculous that people spend all their time talking about it, but there are also really important reasons. And that means that capital gains are passed on. Any capital gains that are generated in that ETF or fund get passed on to you, of course, so that you pay taxes on it. So you'll get that distribution, then you'll pay taxes. Now, why that matters is there are a lot of reasons why you can generate capital gains in an ETF or fund. So the simple reason is they're actively managed and the manager makes a decision to buy or sell something. That can be a capital gain event. But for passively managed ETFs and funds, that can happen if an index changes. And this happens very rarely, but the ASX 200 biggest companies in Australia, well, all of a sudden one company becomes bigger, 201st becomes bigger than the 200th. They have to sell one, buy the other one. But where you're getting a lot of this is when you are in an equal weighted index or you're in something like a thematic ETF, which I always rant about. But a lot of those have automatic rebalancings. So the biggest culprit is there's an ETF called FANG, which invests in 10 technology shares. They rebalance on a quarterly basis to equal weight that index. So that means you're selling the winners and you're buying the losers. And there's a lot of reasons why you want to rebalance, but that rebalancing event means that you are going to get a big tax bill potentially, and you're going to get that distribution. So the problem with this is a lot of people don't understand that that is a distribution and it's not necessarily an income. And these capital gain events can be more lumpy than normal. So that means your income can fluctuate a lot. So go look at the distributions paid out of ETFs. If you're considering them, if you see them bouncing around a lot, it's because probably a lot of it is capital gains. And it's not a case where dividends are getting cut or dividends are getting increased. But people seem to latch on to examples where they get paid out a lot. So this FANG ETF had a huge distribution last year. And everyone's like, wow, it's amazing I'm getting so much income. But if you go look at the underlying shares, 9 out of 10 didn't pay anything. They didn't pay dividends. So this was all capital gains. And anyone who is sitting there expecting that to continue to happen is probably going to be disappointed in the future, especially if the market starts going down. You'll see your income dry up. Because if the market keeps going down, you, of course, are not generating capital gains because you're not gaining anything. So just something to think about. All right, we seem to have a couple questions that we'll get into. All right, so we have a question. Where will there be a recording that we can rewatch? Look at that, Emily. Someone's so excited that they're still watching it and want to watch the replay. It's like me watching Seinfeld over and over again. So yes, we'll put this on YouTube. So if you look at Morningstar Australia YouTube, and also, what about Macquarie Bank? Isn't it not as domestically focused as other banks? Yeah, so Macquarie is different. So with sort of the big four banks, a lot of their business just comes from business lending and retail lending in Australia. You obviously see the branch networks everywhere. Macquarie is a little bit different. So Macquarie gets a lot of their income from other sources. So certainly you hear about all their infrastructure, investment vehicles, and investment banking and everything else. So yeah, not as domestically focused, but different risk profile. All right. So, yep, I thought we were going to get this one. So David says, most LICs and ETFs are heavily weighted to the banks. Very hard to find index funds that are more balanced across all asset classes. Do you have any suggestions for funds that are balanced but still achieve good yields? Okay. So David had a couple good points that we need to, that we'll hit. Number one, let's talk about LICs. I didn't put LICs on here. LICs are different than ETFs and funds. LICs are not pass-through vehicles. LICs are companies, licensed investment company. What that means is that with a LIC, the management of that company can decide the timing where they distribute income and capital gains to you as a shareholder. So what that means is they can smooth out, and if you go back and look at the history, they have. It's a big selling point for particularly retirees that want steady income for LICs, that they are able to smooth out those and actually keep reserves and pay them out when they want to, smooth out those income levels, which a lot of people find very attractive. So something to think about with LICs. But so David says that a lot are heavily weighted to banks. Yeah, I mean the problem that we run into, David, and we'll go through this example. Problem that we run into is there are certain industries that traditionally pay out more dividends, and banks are one of them. And if we look domestically in Australia, banks are certainly one of them. Another one is utilities and infrastructure companies. But the problem with utilities and infrastructure companies is that a lot of them got bought. So private equity purchased a lot of them. So there's sort of famously one utility left trading on the ASX. So that's a problem. And so if you were looking for yield in Australia domestically, a lot of people gravitate towards the banks, of course, and that is concentrating your risk. So there aren't any really great suggestions I have. If you want to look at the ASX 200, for example, one way to diversify away from that is to go for an equal weighted ETF, for example. So instead of putting more money into the largest companies, a lot of which are banks, all of a sudden you're putting the same amount into every single company, but that is going to drop the yield on the investment. So that is where you need to make those trade-offs between the benefits of diversifying your income sources, the hope that maybe over time that companies that have lower yields will grow those dividends faster. But that's an option. But there aren't any hidden giant dividend payers that people aren't aware of. So sorry about that, David. So May is saying, is that why the price of an ETF always falls after each distribution? Yep. So anytime there's a distribution, whether it's a share paying a dividend or whether it's an ETF, you don't just get the free money, the price actually falls, right? So what we're trying to do is we are trying to, of course, with an ETF, there are all sorts of different reasons, but ETFs generally trade pretty close to their NAV. So when they pay you out this giant distribution, they are paying you something real. That net asset value of the ETF drops and it adjusts downwards. Same thing with shares. When a share pays a dividend, it will drop by the amount of that dividend. So Eric says, does Morningstar analysis of companies report that company's beta? So the beta is one of the risk measures that we show. So we do have that. So it's not it is simply a statistical measure that's measured, but you can find beta everywhere. So our analysts generally won't actually call that out in our analysis. It's literally just a statistical measure that you can find in most places. All right, so let's keep moving on because Emily really wants to get to the last slide. AGL, so May says AGL. Yes, AGL. Thank you for answering that. AGL has been in the news a lot. All right, we went over this. Franking credits are good in terms of total returns. That probably shouldn't come as a surprise to anyone. All right, so let's go through this quick case study. So one of the things that we want to consider, of course, as we talked about before, is we want to consider the impact of dividend reinvestment plan. So I wanted to go through, and we actually took this from a guide, wanted to go through and use a real life example so that people could see this. So there's a lot of numbers on here. Let's not worry about those. So when we wrote this guide, I think we wrote it in 2019. So we're, of course, looking at data from when Transurban went public. So Transurban is a company that owns a bunch of toll roads. It's traditionally paid out a pretty high yield. So you can think about that. If you own Transurban, you're driving around Sydney or Brisbane or Melbourne, paying all these really high tolls, you can think, at least I get a portion of my money back. So we're going to look at Transurban. So let's say Transurban started trading in 2009. So you invested $5,020 in 2009. And that means you bought 1,000 shares. Now, why did I pick 2009? I picked 2009 because that was pretty much the low point in Australia during the GFC. And Australia got off pretty well. So it was the first negative quarter GDP growth in 8 years that occurred. And for those of you, I was not living in Australia at the time, but Rudd Labor government announced a $42 billion economic stimulus package. So people were kind of worried about what was going on. All right, but you've gone out and you've bought Transurban. So we've got two examples here. First of all, this is just what happened with Transurban. So these are all their quarterly dividends and the share prices in different periods of time. And yeah, you can basically see their history, and then we've annualized the dividend there. You have two options. You can take the dividend in cash, or you can reinvest it in more shares. So this first scenario, you just take the dividends in cash, which is great. So every year you're getting these dividends and you are seeing growth in your income, which is good. You want that, right? You want growth in your income. Why are you seeing that? You're seeing it because they're paying out higher dividends. You can see it, right? 23 cents, 25 cents, 28 cents, etc. So Transurban had a very good track record of increasing dividends. Now, then 2020 happened, but we're just making an example here. The other opportunity, of course, is you can go back and you can reinvest the dividends in more shares. So you have 1,000 shares here. In this case, your share count with each dividend keeps growing, right? Because you're obviously getting more shares, then the dividends getting raised and getting paid out on more shares, your income growth accelerates. So what we can see here is after this period, we can see the differences in what you're getting paid. So in this case, 2017, you made $545. Here, you made $807. So that is a large increase. So let's go through a couple stats. So if you did not reinvest your dividends, your total income increased over this period by 91%. If you did, you'll have to excuse me. If you just owned it, you made 91%. If you reinvest your dividend grew by 136%. If you didn't reinvest your dividend, if you did, it grew by 250%. So this is basically showing the difference in income growth and the difference in the total income you got over that period. Now, remember, the total income, you're not taking cash, you reinvested it, but still, that is what you earned. So not too shabby. So that's my Transurban example. A couple questions we'll get to in a second. I just want to go through dividend sustainability, then show the slide that Emily's really looking forward to. Then we'll get to the rest of the questions. Emily's sitting in here, by the way. I'm not just gesturing off into nothing. All right. What are we really worried about with dividends? We want to make sure that we are purchasing a company with a sustainable dividend. So what are some of the different things that you can look at? Number one, you can look at the Morningstar Economic Moat Rating. So a moat rating, of course, looks at the sustainability of the competitive advantage that a company has. So Buffett term, we rate all the companies wide, narrow, no moat. That's if our analysts think they have that sustainable competitive advantage, that they're able to keep competitors at bay, and by doing that, earn higher returns for what they invest in the company and keep margins up. That is all good for dividends, right? So if companies continuing to do that, less opportunity for them to cut dividends. So that's one thing you can look at. You can just look at revenue growth, right? So at the end of the day, if we can continue to grow revenue as a company, that is a good thing. So these are both, I classify these both on the good side. Like we're trying to find great companies that won't have to cut their dividend. A couple of things that you can also look at that potentially could show a threat to the dividend is customer concentration. So basically, if a good amount of your revenue is coming from one customer, that creates problems for you as a company. Number one, that customer could leave. So of course, that's a problem. Number two, of course, that customer has a lot of power to negotiate with you. In this hypothetical situation, let's say they make up 50% of your revenue. Well, they know that. And so next time you're negotiating a contract, they probably know they have some leverage. What we want is companies with a very diverse set of customers. Like if I stop buying Cokes, Coca-Cola would probably be okay. Recurring revenue. So these are companies we all like. We all like this subscription model. What is the percentage of recurring revenue we get? So Apple's always an example that we talk about, what Apple has been doing. So instead of just selling an iPhone, right, if they just sell me a phone, they get revenue once. And maybe I'll buy a new iPhone whenever I need one. But if they have recurring revenue, if I am paying them every month for cloud storage, for an example, or I'm paying them every month for Apple Music or Apple TV, that of course is recurring revenue that does not involve them having to go out there and sell me a new phone. So we like companies with high recurring revenue. Margins, we want to pay very careful attention to margins. So once again, margin is, at the end of the day, you go sell something, that's your revenue. But then you have to pay a lot of expenses to produce that, to run the company, everything else you're trying to do. How much do you get to keep? So a sign where we would start worrying about dividends, if you're seeing that margin compress, companies keeping less of everything they sell, which means there's less for you and me if we're shareholders, which means it could be a sign that the dividend might not be sustainable. Dividend payout rate. Talked about this with Australia, right? The higher the dividend payout rate, the more difficult it is to maintain. Let's say that a company pays out 90% of their earnings in dividends. Well, let's say there's a recession, their earnings drop by 20%. Well, now they're in trouble, right? So they're probably going to cut that dividend. If a company's paying out 50% of their earnings in dividends, you have the ability to maintain that dividend even if the company loses a lot of that revenue or a lot of those earnings. One thing about payout rate that everyone should keep in mind is certain industries will have payout rates that are consistently over 100%. I'll do that because of the differences. I won't go through all of this right now because we don't have that much time, but they'll do that because they work in an industry that has high levels of depreciation. So you'll see this with real estate investment trusts. You'll see this with utilities, if you can find one. You'll see this with infrastructure companies that have a lot of assets on the balance sheet that they're writing down. So that is a non-cash charge. There's a lot of arguments about depreciation, but anyway, it's a non-cash charge, which means they can potentially maintain a dividend payout rate over 100. So just remember that. And then finally, financial strength. So of course, paying out a dividend, just the act of paying out a dividend shows that the company has some confidence in their financial strength, but also you want to assess that. And we can look at all sorts of things. We can look at their overall debt levels. We can look at their debt maturity schedules. So do they have a lot of debt coming due? We can look at interest coverage ratio, which looks at how much are they earning above how much they pay out in interest. There's all sorts of different metrics we can look at, but you want a company that's in strong financial shape. And in our analyst report, we've got a section called capital allocation that talks a little bit about their balance sheet, as well as the capital allocation decisions they make, the sustainability of their dividend, according to our analysts. All things you want to look at. All right, so before we get to questions, this is the slide that Emily was so excited about. So she's somewhat laughing. So that's Jimmy Buffett. And I just like this quote because, Jimmy Buffett is, even though he clearly works very hard and is a very good businessman, everyone thinks he's this laid-back guy that just lives on the beach. And it is this sort of dream of passive income, right? That we just sit on the beach and have drinks and just collect our dividend checks, which make us happy, like Rockefeller, who did not need extra income. All right, so let's go through a couple questions that we have left. I hope that was everything you were looking for, Emily. She looks thrilled. All right. So Grant says dividends in cash can be invested in cash for a small return. So income for that scenario should be a little more. Okay, good point. So obviously, in that Transurban scenario that I went through is that, yeah, you'll make a little something off of cash. And frankly, back when I was looking at that, right, it ran from like 2009, you made more in cash. So you can, of course, there are other uses for cash. The other thing I'd say about dividend reinvestment, of course, is what that doing is reinvesting in the same company. Many people decide that they'll do something different, that they will simply take cash in their portfolio and then they'll invest it where they want. They're not taking it out. They're just investing it in different companies and different opportunities that they see. So something to think about. Chris says, in a recession, like the GFC, companies may go under and all the dividend reinvestment with it. Yes, that is the other risk, of course, right? That, if we go back to that Transurban scenario, I don't remember the exact numbers. If I took the cash, that's great. That's my money. right? That's why people like dividends, because it's tangible and it flows into your account. So even if Transurban went out of business, I still got that $3,000 in dividends. If I reinvest all my dividends, of course, the risk is that if the company goes out of business, it's all gone, right? I got no dividends in reality because the shares that I bought are gone. So that's a good point, Chris. All right, a couple other questions. Let's see. So John says, I like Transurban example, but does ignore the fact that if you didn't reinvest, you would probably invest somewhere else. Okay, John, good point. That's what we got from the other. Obviously, that would increase or decrease returns. Also need to keep records forever for tax reasons. That is true. So dividend reinvestment can be frustrating from a tax perspective. All right, so John's saying, another John, any building companies which generate dividends considered to be fundamental. I'm not exactly sure what you mean by building companies. I don't know if you're talking about companies that are just sort of developing and younger in their life cycle, or like literally a building company like Lend-Lease or something like that. But yeah, think about the industry. So, industries that potentially have higher volatility in earnings. You can see big fluctuations from dividends. So we saw really big dividend payouts from a lot of the miners, and sort of off of that surge and commodity prices that we saw that sort of came back and is now happening again. But think about that. A lot of them are price takers, meaning that they will sell their commodity for whatever the price is. They have no control over it. So just think about that. That can add some more volatility into dividends. So you'll see a lot of those companies will, and what we saw sort of at the end of last year, a lot of those companies will pay out special dividends. So they are not, quote unquote, on the hook for doing it again. So think about that. So at the end of the day, right, like the stability of a dividend is also very industry specific. Think about the stability of that industry and of that company. All right. So we made it to 157, which is good. Almost made it through the whole thing. Emily's looking bored. So we're going to end this. But if people do have questions, you can email me at mark.lamonica1@morningstar.com. So thank you guys very much for joining. Hope you enjoyed it. And I'll be back on Thursday. We'll talk about, somewhat related, the FIRE movement. So financial independence, retire early. Unless I retire between now and Thursday, then Emily will have to do the webinar. So she can talk about the FIRE movement because it's everyone your age that's really into it. All right.